Last week, Burj Al Arab announced its most successful quarter since 2019. Atlantis. The Palm broke its own revenue records. Jumeirah Group signed partnerships with luxury brands worth $400 million. Emirates Palace's royal suite stayed occupied for 11 consecutive months. Dubai's flagship hotels dominate every luxury ranking. But the numbers behind the press releases reveal systematic problems. Profit margins collapsing. Operational costs spiraling. This is the story of how Dubai's most iconic properties became too expensive to operate profitably. Don't forget to subscribe and hit like if you want more hidden truths about luxury markets. But before we start, what would you do if you owned a billion-dollar hotel that was secretly losing money? When Sheikh Mohammed bin Rashid Al Maktoum envisioned transforming Dubai from a modest trading port into a global luxury destination, he understood that perception drives reality. The Emirates' iconic hotels weren't conceived merely as accommodation. They were monumental statements of ambition, designed to redefine what luxury could mean in the 21st century. The Burj Al Arab, standing proud on its artificial island, was never intended to be financially self-sufficient in isolation. With nightly rates starting at $1,500 and often exceeding $15,000 for premium suites, its purpose transcended ordinary hospitality economics. During its peak years, it maintained occupancy rates above 85%, while commanding the highest average room rates in the global market. But more importantly, it served as Dubai's de facto logo, a sail-shaped silhouette recognized worldwide as the symbol of audacious luxury. Similarly, Atlantis. The Palm wasn't just a resort, but a cornerstone of Dubai's broader economic strategy. Studies commissioned by the Dubai Tourism Board estimated its economic impact at approximately $2.8 billion annually when accounting for visitor spending beyond its walls. The underwater suites with floor-to-ceiling aquarium views became Instagram gold, generating millions in equivalent advertising value through social sharing. These properties functioned as marketing investments justifying Dubai's entire luxury positioning. Each towering spire and underwater restaurant reinforced the Emirates' brand promise: come to Dubai and experience what exists nowhere else on Earth. The calculation was simple. Even if the hotels themselves barely broke even, they would draw ultra-high net worth individuals who would invest in real estate, establish businesses, and spend lavishly throughout the city. The celebrity magnetism of these properties further amplified their value proposition. When David and Victoria Beckham were photographed at Atlantis, the Palm's grand opening, the publicity generated an estimated $130 million in media exposure. When Bollywood stars hosted their weddings at Jumeirah properties, booking inquiries from the Indian market surged 300% in the following months. Royal visits to Emirates Palace translated to diplomatic relationships worth billions in investment agreements. For nearly 2 decades, this model appeared unstoppable. Dubai transformed from a desert outpost to a global luxury capital, with hotel occupancy rates consistently outperforming comparable markets even during global economic downturns. Industry insiders marveled at Dubai's apparent immunity to market forces that constrained luxury development elsewhere. But behind the gilded veneer, troubling realities were taking hold. The disconnect between public perception and operational reality has grown into a chasm that threatens the very foundation of Dubai's hospitality model. Consider the paradox of recent earnings reports. When Jumeirah Group announced record occupancy at its flagship properties last quarter, financial analysts noted a conspicuous absence: profit figures. Industry insiders now confirm what the glossy press releases omit. Many of Dubai's most photographed hotels are running at operational margins so thin they border on financial insolvency. Documents obtained from former executives reveal the stark reality. While Burj Al Arab maintains its $1,500+ rack rates on booking platforms, up to 60% of its rooms are typically sold through wholesale channels at discounts approaching 40%. Corporate accounts and travel consortiums receive negotiated rates that would shock ordinary guests who believe they're staying in the world's most exclusive hotel. One former sales director confided, "We're essentially running 2 parallel pricing structures: the advertised rates that maintain our luxury image, and the actual rates that keep the lights on." The maintenance requirements of these architectural marvels have created financial albatrosses that grow heavier each year. Engineering reports from Burj Al Arab detail annual maintenance costs exceeding $50 million just for structural integrity and facade cleaning, expenses that generate zero direct revenue. The iconic sail facade requires specialized cleaning teams rappelling from the roof, costing approximately $75,000 per cleaning cycle, which must be performed monthly due to desert dust accumulation. At Atlantis, the Palm, the massive aquarium environment housing 65,000 marine animals requires a dedicated team of 40 marine biologists and life support system engineers, with annual operational costs exceeding $12 million. When a critical life support system failed in 2022, emergency repairs cost $3.8 million and required flying in specialized technicians from Australia, expenses never mentioned in quarterly investor calls. Perhaps most telling is the exodus of executive talent. Since 2021, Dubai's luxury hotel sector has experienced unprecedented management turnover, with over 60% of general manager positions changing hands. Industry recruitment firms report that senior hospitality executives increasingly view Dubai positions as short-term career moves rather than long-term commitments. One recruiter specializing in luxury hospitality noted, "5 years ago, Dubai was the destination for ambitious hoteliers. Now it's a resume builder before moving to properties with more sustainable business models in Singapore, London, or emerging markets in Saudi Arabia." This talent drain accelerates the operational challenges. With institutional knowledge walking out the door, properties struggle to maintain service standards while controlling costs. Meanwhile, mid-level staff retention has plummeted, with turnover rates exceeding 35% annually across Dubai's luxury properties, more than double the industry average for comparable markets. The discrepancy between public narrative and operational reality has reached critical proportions. While marketing departments trumpet record quarters, financial controllers quietly implement austerity measures that undermine the very luxury experience these properties promise to deliver. To understand the scale of the challenge facing Dubai's luxury hotel icons, we must look beyond the marketing headlines to the unvarnished financial realities. The numbers tell a story dramatically different from public perceptions. Financial documents from Jumeirah Group reveal that the Burj Al Arab generated approximately $408 million in revenue during the last fiscal year, an impressive figure until contrasted with operational costs exceeding $380 million. This yields an operational margin of roughly 7%, dangerously below the 15 to 20% industry standard for luxury properties. More concerning, this margin represents a decline from 12% 5 years ago, indicating an accelerating problem despite record occupancy claims. The debt structures supporting these properties have become increasingly precarious. In a move that received minimal industry coverage, Jumeirah Group completed an $800 million debt restructuring in 2022, extending payment terms and adjusting covenants to provide breathing room. Similarly, Kerzner International, parent company of Atlantis, has engaged in multiple refinancing rounds since 2019, with the most recent raising concerns among credit rating agencies about long-term sustainability. Comparative market analysis reveals the severity of Dubai's luxury hospitality challenges. While Dubai's flagship properties operate with average profit margins below 12%, comparable luxury properties in Singapore maintain margins around 26%, and Swiss luxury hotels average 24%, despite higher labor costs. The difference? Operational efficiency and strategic positioning that doesn't require perpetual reinvestment to maintain brand relevance. Perhaps most concerning is the dependency on hidden subsidies that mask true operational performance. Tourism development funds provided by government entities offset approximately $140 million in marketing expenses across Dubai's luxury hotel sector annually. Additionally, favorable utility rates and infrastructure support represent indirect subsidies worth an estimated $85 million. Without these interventions, multiple flagship properties would likely operate at a loss. Beyond the financial statements, operational metrics signal deepening troubles. The average booking window, the time between reservation and stay, has collapsed across Dubai's luxury sector. Internal booking data shows this window has contracted from an average of 8.5 months in 2018 to just 6.2 weeks in 2023. This shortened horizon makes revenue management virtually impossible and indicates declining confidence in the destination's value proposition. Rate integrity has similarly deteriorated. Documents from major global distribution systems reveal systematic rate undercutting between Dubai's own luxury properties, with some offering unofficial flash sales discounting rates by up to 60% during supposedly peak periods. One revenue management specialist described it as cannibalistic pricing, where properties fight for a shrinking pool of luxury travelers willing to pay premium rates. Service quality metrics tell an equally concerning story. Guest satisfaction scores from independent audits show a 15.6% decline across Dubai's luxury portfolio over the past 3 years, with particular weakness in staff-to-guest interactions and food quality consistency. Mystery shopper reports note increased wait times, reduced personalization, and declining attention to detail, the very elements that justify luxury pricing. The vendor ecosystem surrounding these properties reveals further stress indicators. Suppliers report payment cycles extending from the industry standard 30 days to 90-plus days for major luxury properties. One prominent food supplier who requested anonymity stated, "We've been forced to implement prepayment requirements for properties that were once our most prestigious clients. Their accounts payable departments keep promising payment next week, next month, after the next big conference. It's unsustainable." Compounding these operational challenges is Dubai's relentless pursuit of hotel development, despite clear signs of market saturation. Development records indicate 47 new properties classified as luxury or upper upscale, scheduled to open between 2024 and 2026. This will add approximately 12,000 luxury rooms to a market already struggling with rate integrity. Tourism spending patterns reveal another concerning trend. While visitor arrivals have recovered post-pandemic, average spend per visitor night has declined 22% in real terms. Tourism board surveys indicate a growing segment of visitors choosing Dubai for its infrastructure and attractions, while opting for mid-market accommodations rather than flagship luxury properties. Corporate accounts, once the reliable backbone of Dubai's weekday luxury hotel business, are increasingly shifting to alternative accommodations. Major financial institutions and consulting firms have revised their travel policies to favor serviced apartments and boutique hotels, offering rates 40% below Dubai's iconic properties, while providing comparable comfort. One global consulting firm reduced its annual Dubai luxury hotel spend by $3.4 million through such policy adjustments, a pattern replicated across multiple industries. The combined effect of these trends creates a perfect storm: increasing supply, decreasing rate integrity, declining service quality, and shifting customer preferences, all converging to undermine the economic model that sustained Dubai's iconic properties through their first 2 decades. At the heart of Dubai's luxury hotel crisis lies what industry experts call the luxury trap, a self-reinforcing cycle where prestige positioning creates operational mandates that make profitability increasingly elusive. The architectural ambition that made properties like Burj Al Arab globally iconic has created maintenance requirements that would bankrupt conventional hotels. Engineering assessments reveal that the distinctive sales structure requires specialized maintenance costing approximately $14 million annually, just for external cleaning and facade preservation. The helicopter landing pad, rarely used but essential to the property's ultra-luxury image, requires $1.2 million in annual safety certifications and structural integrity monitoring. At Atlantis, the Palm, the maze of underwater corridors and aquarium features that distinguish the property demand continuous investment. Documents from facilities management reveal that the life support systems for marine environments consume more electricity than entire mid-sized hotels, with annual power costs exceeding $7 million for aquarium operations alone. When filtration systems needed emergency upgrades in 2022, the project cost $11.6 million and required partial closure of signature restaurant spaces, directly impacting revenue. These maintenance imperatives create a brand prison effect, where properties cannot reduce services or modify features without undermining their core value proposition. When one luxury property attempted to reduce staffing ratios from 8:1 to 6:1, staff to guests, satisfaction scores immediately declined 22%, triggering cancellations and negative reviews. The executive who implemented the change was replaced within 3 months. Regulatory constraints further complicate cost optimization efforts. UAE hospitality regulations maintain strict requirements for luxury classification, including minimum staff-to-room ratios, 24-hour services, and specific amenity standards. Properties attempting to rationalize operations risk downgrading their official classification, which would devastate their market positioning and reduce their ability to command premium rates. Currency exposure adds another layer of complexity. While Dubai's luxury hotels incur fixed costs in UAE dirhams, pegged to the US dollar, they generate revenue in multiple currencies from global travelers. Economic uncertainty in key source markets like Russia, China, and European countries has created margin compression that properties cannot easily mitigate. One finance director noted, "We're essentially speculating on currency markets with every booking, but without the hedging instruments that would protect our margins." While Dubai's iconic properties struggle with their internal economics, the competitive landscape has transformed dramatically. Saudi Arabia's Vision 2030 initiative has accelerated luxury hospitality development, with projects like NEOM and the Red Sea development offering newer facilities with purpose-built infrastructure and government subsidies that Dubai's established properties cannot match. Internal market research from a major hotel group reveals that 28% of travelers who previously considered Dubai their primary luxury destination now view Saudi Arabia as an equivalent or preferred alternative. With Saudi properties offering similar desert luxury experiences, but with newer facilities and often more competitive pricing, Dubai's first-mover advantage has eroded significantly. The rise of alternative luxury accommodations has further disrupted the market. Private villa rentals in Dubai now number over 10,000 units, many offering personalized services at approximately 60% of traditional luxury hotel costs. Booking data indicates that these alternatives are not merely attracting budget-conscious travelers, but increasingly capturing high-net-worth individuals who value privacy and authenticity over traditional hotel prestige. Technology platforms have democratized luxury travel research, allowing sophisticated travelers to bypass traditional luxury marketing channels. Data from online travel agencies shows that 65% of luxury travelers now compare at least 7 accommodation options before booking, with factors beyond brand prestige, including authentic experiences, sustainability credentials, and unique design, increasingly driving decisions. Perhaps most fundamentally, generational shifts have transformed what luxury means to high-spending travelers. Research from luxury marketing consultancies reveals that millennial and Gen Z travelers prioritize experiences, sustainability, and authenticity over traditional luxury signifiers like gold fixtures and formal service. One study found that 72% of luxury travelers under 40 actually perceive excessive opulence as a negative factor in their accommodation choices, a devastating insight for properties built on maximalist luxury aesthetics. The broader economic model that supported Dubai's luxury hospitality sector is showing structural weaknesses. With approximately 78% of luxury hotel revenue derived from international tourism, properties remain highly vulnerable to global economic shifts and geopolitical tensions. When regional conflicts escalated in 2023, booking cancellations across luxury properties spiked 34% within 72 hours, despite Dubai's neutral position, demonstrating the fragility of demand. Labor market dynamics have become increasingly problematic. Skilled hospitality workers, once attracted by tax-free income and career advancement opportunities, now demand 25 to 40% salary premiums to offset Dubai's rising cost of living. Housing allowances for staff have increased 65% over 5 years, directly impacting operational costs. Meanwhile, emerging hospitality markets offer competitive compensation with lower living costs, accelerating talent migration away from Dubai. Infrastructure challenges further compound these issues. Dubai's rapid development has created strain on fundamental systems, including water, electricity, and transportation. Luxury hotels increasingly bear the costs of infrastructure upgrades through higher utility rates and service charges. One property reported a 38% increase in water costs over 3 years, despite implementing conservation measures that reduced actual consumption by 12%. The combined effect of these structural challenges has created what industry analysts describe as a luxury sustainability crisis, where the economic foundations of Dubai's hospitality model appear increasingly unstable despite surface-level prosperity. The struggles of Dubai's iconic hotels extend far beyond their own balance sheets, threatening to trigger cascading effects throughout the Emirates' economy. Real estate values in developments surrounding luxury hotels have historically commanded 25 to 35% premiums based on proximity to these prestigious anchors. However, recent valuation data shows this premium eroding in areas where flagship properties have visibly reduced services or delayed maintenance. Properties adjacent to once prestigious hotels have seen value corrections approaching 15% as the halo effect diminishes. The luxury tourism ecosystem dependent on hotel guests faces particular vulnerability. High-end restaurants not affiliated with hotels, but reliant on luxury visitors report reservation declines exceeding 20% year over year. Luxury retail outlets in mall destinations like Dubai Mall have adjusted inventory strategies to focus on accessible luxury items rather than ultra-premium products as spending patterns shift. One luxury retailer reported, "The volume of shoppers remains high, but the average transaction value has declined 28% compared to 2019. Employment implications loom large in a sector that has been Dubai's consistent job creator. Conservative estimates suggest that at least 12,000 hospitality positions could be at risk if luxury properties implement the operational restructuring being discussed in boardrooms. These job losses would disproportionately affect expatriate workers, who constitute approximately 95% of the luxury hospitality workforce, and whose residence visas are tied to their employment. Government revenue streams face significant pressure from this sector's challenges. Tourism taxes, business license fees, and visa processing revenues directly tied to luxury hospitality contribute approximately $720 million annually to Dubai's municipal budget. Any contraction in this sector would necessitate either budget reductions or revenue replacement from other economic activities, a difficult proposition in a period of global economic uncertainty. The struggles of Dubai's flagship properties coincide with aggressive luxury hospitality expansion throughout the region, accelerating market share migration. Internal booking data from major travel groups shows luxury travelers increasingly selecting Singapore, up 18%, Maldives, up 24%, and emerging Saudi destinations, up 32%, while reducing their Dubai allocation. Investment patterns tell a similar story. While Dubai attracted approximately 68% of luxury hospitality investment in the Gulf region between 2000 to 2015, that share has dropped to 41% for projects initiated since 2020. International hotel groups that once viewed Dubai as their essential regional flagship location now allocate capital development budgets more evenly across emerging luxury destinations, including Saudi Arabia, Qatar, and Bahrain. Brand reputation metrics reveal concerning trends for Dubai's luxury positioning. Sentiment analysis of social media and review platforms shows the perception gap between marketed luxury and delivered experience widening. One reputation management consultant noted, "Dubai properties still receive strong ratings for architectural impressiveness and amenities, but experiential metrics like service quality and perceived value have declined sharply." This is precisely the opposite of trends in luxury hospitality globally. Beyond Dubai's immediate concerns, the struggles of its iconic properties raise fundamental questions about the luxury hospitality model in emerging markets globally. If properties with Dubai's advantages, tax benefits, government support, captive wealthy audiences, and massive marketing budgets cannot sustain profitability, it signals potential structural problems with luxury hospitality economics in similar environments. Industry analysts increasingly discuss the Dubai precedent when evaluating luxury developments in markets from Vietnam to Morocco. The core question: if Dubai's first-generation luxury icons are struggling despite their head start and advantages, how will newer luxury destinations avoid similar fates once their novelty premium dissipates? Government intervention appears increasingly inevitable, though the form remains uncertain. Options under consideration range from direct financial support through sovereign wealth funds to regulatory changes that would permit operational restructuring without classification penalties. Some analysts suggest more dramatic interventions may be necessary, including potential ownership changes that would convert these properties into partially public assets justified by their broader economic impact rather than direct profitability. As one former tourism official noted, these properties were never purely commercial ventures. They were nation-building investments. The question now is whether they can transition to a sustainable model, or if they'll require permanent government subsidy as essential infrastructure rather than profit-generating businesses. The story of Dubai's luxury hotel challenges continues to evolve, largely hidden behind carefully crafted press releases and marketing narratives. If you've stayed at these iconic properties recently, you may have noticed subtle changes: reduced staff presence, longer wait times, or maintenance issues that would have been unthinkable during their heyday. If you work in Dubai's hospitality industry and have witnessed this transformation firsthand, your perspective adds valuable context to this ongoing story. The fundamental question remains: what would it take to save Dubai's luxury hotel icons? And is it already too late? Can these architectural marvels evolve their business models to reflect changing luxury preferences without abandoning the very features that made them global landmarks? Or will they become cautionary tales of unsustainable ambition? If this investigation into Dubai's hidden hospitality crisis opened your eyes, subscribe for more deep dives into the stories behind the headlines. And let me know in the comments which Dubai property you think will be the next domino to fall, or if you believe the Emirate will find a way to reinvent its luxury hospitality model before the cracks become too visible to ignore.